This uncertainty, the whole area, the Strait of Hormuz, has prompted a new acronym on Wall Street. Now, you are familiar with, let's see if I can get it to stand up properly, the TACO. Well, it's not going to stand. There we go. The TACO, which, of course, Trump always chickens out. Now, let's go from tacos to nachos. And the nacho stands for, of course, not a chance the Hormuz opens, Straits of Hormuz opens. It reflects a fear that the Straits closure will not be short-lived, particularly as the administration's pressuring foreign governments to help support freedom of navigation in the Strait. Andrew Lipow is the president of Lipow Oil Associates, with me from Houston, Texas. The sort of variant of the nacho is that the market has pretty much accepted that the Straits are not going to open anytime soon. Is that a fair assessment or not?
Well, I think that oil prices could continue to go up the longer that the strait is being closed. After all, we're losing a net of about 14 million barrels a day of crude oil and refined products. The total loss since the war has begun is in excess of 750 million barrels. And the problem that the market has is once we run through the strategic petroleum reserves that have been released by various governments and the commercial inventories that are available, what do you do then to make up the shortfall?
Well, I guess the answer is you don't, and that's where you get the shortages, and that's where you get to. But the economic damage that's taking place now, you know, with tariffs, you talk about tariff substitution. Eventually, human behavior buys other goods. They shop elsewhere. The tariff ceases to have as much power as it did. Is there anything equivalent in terms of our behavior that we will adapt so that this oil, this lack of oil, becomes less relevant?
Well, there's two choices in the near term. Either prices go up and that encourages demand destruction, or you have rationing, which is a form of demand destruction put in by governments. And we are actually kind of seeing both. You see lower demand through many countries in Southeast Asia, and you see cooking gas or LPG being rationed in India and China as countries take steps in order to try to cope with the shortfall.
Is there an unrealistic reality here in the United States? I'm in New York, you're in Houston, where at the moment the only effect seems to be gas prices have gone to $4.5 a gallon, and people are getting hot under the collar. But there's no talking of rationing. Fuel supplies, both for jet fuel and for others, are there, and they're not likely to be affected seriously for months. Though it's the rest of the world that's bearing the brunt here.
Well, that's certainly true. I mean, you saw, the jet fuel crisis, if you will, spread from Asia to Northwest Europe, and to a lesser extent here in the US, because to cope, airlines are canceling flights and reducing schedules. But what's really concerning is if you were to look at diesel inventories in the US, down 17% since early February. Gasoline inventories as we go into the driving season, down 14% since early February. And so this does not bode well as the U.S. is exporting record amounts of crude oil and refined products to satisfy shortages elsewhere. And you simply cannot continue the drawdown indefinitely. So there is going to be a crunch point, and I'm very concerned about diesel inventories reaching a critical level over the next month.
The president believes that people will be prepared to pay higher gas prices. It's a price that'll have to be paid. However, have a listen to what he said today on the question of when prices might fall. And I'd like to hear your thought.
The gas will go down. As soon as the war's over, it'll drop like a rock. There's so much of it. It's all over the place, sitting all over the oceans of the world. And it'll go down. But what won't happen is if Iran had a nuclear weapon and used it, then the whole world is a different place.
What about
You're not going to have to pay a little bit more for gasoline. The gasoline, the oil will go down rapidly as soon as the war is over.
Do you go along with that? The price will go down the moment the war's over?
Well, I do. I think the market would react to the end of the conflict, and you'd certainly see crude oil prices drop $10 to $15 a barrel, that doesn't mean supply is going to immediately be replaced throughout the logistics system. But I think the market will react, and that would cause the gasoline futures and wholesale prices to drop as well. But where I do disagree is it's not necessarily true that gasoline is just floating all over the place and it's just waiting for someone to buy it. There's, in the normal course of business, gasoline is moving amongst the different continents. The US, we're moving gasoline to Australia.
I'm grateful. Andrew, look, let's agree, you and I, that we'll talk more on this because I need your insight. You're well plugged into the markets and how this is going to move forward. Thank you, sir.